So let's begin with the government. And how the government is entering this model is through government purchases. Government purchases, which we're just going to denote G0. So this is the amount of expenditure the government makes on goods and services, as well as taxes. And we're going to call capital T the tax revenue. This is the total tax revenue. And so we're going to talk about exactly how we're going to model the taxes and how governments are, what rates they're going to charge in terms of taxes in a second. But in terms of the budget, we take government purchases and we subtract the tax revenue. That will tell us if we have a budget surplus or a balanced budget or budget deficit. So if it equals 0, we have a balanced budget, as the government has a balanced budget. If this is greater than 0, that means government purchases are bigger than tax revenue. That'll be a surplus, a budget surplus. And if it's less than 0, then there's a budget deficit. And so when we're talking about government purchases, we're talking about all layers of government. We're just really simplifying things. So in Canada, there's municipal and provincial and federal spending. We're kind of lumping them all together. So we're kind of modeling them all at once. Same with the taxes. We're not separately modeling like federal taxes versus municipal versus provincial taxes. So this is the essential role of government. They're going to make purchases in the economy, and they're going to tax to fund these purchases. There's nothing that says that we have to have a balanced budget or anything like that. But let's kind of get more into what taxes look like in a second here. All right, so let's kind of talk a little bit more about the tax rate. So remember, T was tax revenue. And the assumption we're making about the form of these taxes is that we're going to have some tax rate. So capital T or tax revenue is lowercase t times y. And so remember, y is the actual national income. And here what T is this net tax rate. So we see that as actual income goes up, our tax revenue is going to go up because we're taxing this constant, percent of national income. So it might be like 0.2. For instance, would be like a 20% net tax rate. And so let's kind of see where we're at in terms of the larger model here. So we have this desired aggregate expenditure. So that's that theoretical side of national income. We talked about last week, or last module, consumption and investment. And now we've added this government. So we're going to talk about exports next, but what we've done so far today, or in this lesson, is talk about how G is just some constant G0. The government either raises or lowers their purchases. And we're going to assume our taxes are TY. What we assumed last week is that the consumption function had this form, and investment was some autonomous amount of investment, some constant, just like the government was. And remember that YD is Y minus capital T. It's disposable income, YD, so it's after-tax income. All right, so that's how the government is kind of entering this model. They make purchases, they fund those purchases with taxes. Now we can move on and talk about what net exports look like, or how we're going to model net exports.